These are the 3 most common bookkeeping mistakes, and you're most likely making them if you're a small business owner DIYing your own books. The number 1 most common mistake is commingling expenses. And this isn't a wild guess. I have seen this in every single set of books that I've looked at. Commingling expenses is when you don't keep your personal and your business expenses separated. If you mix your business and personal expenses, this can cost you a ton of time and money and cleanup at the end of the year to separate them out to file your tax return. In addition to that, if you're a limited liability company, mixing your business and personal expenses can cause you to lose your limited liability protection if you were to be sued. The number 1 way I see my clients commingling their expenses is through credit card use. They have credit cards that are in their personal name that they're using for their business, and they use their business credit cards for personal expenses. The easiest way to resolve this issue is to keep your credit cards and bank accounts separate. Put a bank account and credit card in your business name and keep the ones in your personal name separate, and use only the ones in the business name for business expenses and the one in your personal name for personal expenses. It sounds simple, but you might find yourself in line at the store and your business account is running a bit low, so you pull out your personal card and go ahead and use it. And that might lead to a ton of cleanup at the end of the year, so that's why you hire me and I do it. But if you can avoid it, you'll save on tons of bookkeeping costs at the end of the year. The second mistake I see most frequently is the way that owners take money in and out of their company. The way that this is done is through capital contributions, distributions, and through payroll. If you're a sole proprietor or partnership, money is moved in and out of the business through capital contributions and distributions, which are on the equity portion of the balance sheet. So the most common error I see with capital contributions and distributions is that they're recorded as an income or expense on the profit and loss instead of being recorded as contributions and distributions on the balance sheet. An example of a problem this may cause is someone that I've worked with had a $47,000 capital contribution recorded as income in 2023. This resulted in her being taxed on an extra $47,000 in revenue that wasn't really revenue. And when she went to go submit her financials for a bank loan, technically over-reporting her income could be considered mortgage fraud. The third most common mistake is not regularly reconciling your accounts to your bank statements. Most people wait until tax time to go in and reconcile all their accounts, but it's best practice to do so monthly. And that's because not only do banks sometimes make mistakes, but you can catch fraudulent activity as well. A recent example of this is one of my clients had someone take a fake ID with his name on it to a bank branch in Seattle, Washington, and withdraw $3,000 of his money from his account. And we caught it by doing his monthly bank reconciliation. The bank typically only gives you 60 days to dispute fraudulent transactions, so if we weren't reconciling his accounts monthly, he could have lost the opportunity to get that money back. My name is Jordan Joyce, and I started my own bookkeeping company, Jordan J Bookkeeping, because I noticed so many small business owners having trouble correcting these errors on their own. And if you are doing your bookkeeping yourself and you found this information helpful, please like and subscribe and leave a comment below to let me know which of these errors you'd like to learn more about. I'm Jordan J. See you next time.